Welcome to Cheques and Balances. I'm Michael Vincent, this is James Blair, and this week, investing in the share market.
Great, so today's topic, Mike, investing into the share market. It's one of those topics where some people are doing a really good job, some people are doing an awful job,
Absolutely.
and others are just like, what the heck is the share market all about? So in this office, we talk a lot about investing in property, and it's a very New Zealand thing to do.
Absolutely.
We've got this beautiful sign behind us, needing money for real estate. I don't think we need that lit up today, because it's all about property. Let's drop the sign. Great, okay. So today, stock market is really about a 101. So we're going to talk about different ways that you can invest into the stock market, and Mike's going to ask me some questions as we go.
See if you got the answers. I mean, let's start with the basic stuff, right? So James, what is the stock market? What is the share market?
Great. So the share market, if you think about it at a basic level, the share market is really going, well, what is the economy? The economy, to some extent, is companies. So companies either producing a good, producing a service, and they're hopefully making a profit. So a lot of those companies will say, well, let's list that publicly so we can raise more capital and everybody have a little bit of a piece of the pie. So for example, if you owned a piece of Fisher & Paykel Healthcare over the last 10 years has been a great story in New Zealand. They're producing respiratory systems and a whole bunch of other things in New Zealand and around the world. If they are doing a really good job, that stock will go up in value. So there'll be a dollar figure and a number of shares. And they also might pay you a dividend if they make a good profit and have some spare cash.
How often do you sort of receive those dividends?
It really depends on the company. So some companies won't pay a dividend at all. Some might be quarterly, some might be 6 monthly, some might be annually.
That makes sense. So if I like the look of a company, like the look of, say, investing in it or owning a piece of it and maybe getting a bit of that dividend, how do I invest in the share market?
That's a great question. There's three kind of key ways that you can invest into the stock market. We're going to talk about each of them. We're going to talk about the pros and the cons, and then how you can get involved. And it'll really depend on you, your interests, and your life. So if you've got a busy life, you might want something a little bit more easygoing, knowing you're heading in the right direction. So of those three options, we have what we call direct investing, passive investing, and active investing. Now, all of those are really doing the same thing in a different way. So they're all investing into the share market. So you're either owning one company or lots of companies. Now, Mike, I think in the second episode, I coined myself as Statman. So I've got some great stats for you today. Would you like to hear a couple?
Lay them on me.
So the S&P 500 is the top 500 companies in the US. So over the last 50 years, I know you can see my notes in front of me, Mike, so I won't ask you to guess. Over the last 40 of those 50 years, the S&P 500 has gone up in value. So if you invested, you would have been happy and getting a really good outcome. As an average return over those 50 years, the return's been around that kind of 10% mark.
And how does that gauge against, say, other investments like property?
Well, if you look at property, the return, I think, in New Zealand over the last, 10 years is around that kind of 6.9% as an average. So the S&P 500 has done really well. The thing you've got to keep in mind, though, Mike, is the amount of ups and downs with the stock market opposed to property, which is a whole different podcast. But while of those 50 years, 40 years it's gone up, there's been 18 of those 50 years where you've had more than a 20% return. So you are very happy with your financial advisor if you're making a 20% return, unless you've got maybe a bit of dog coin and you've kind of had huge returns in the last couple of days. On the flip side to that kind of really great return is there's more of a downside. So 3 of the last 50 years, you've had a 20% drop or more. So that's a really big, like if you had $100,000, you've now got $80,000.
And should that make investors nervous?
Well, investing into the stock market is not for somebody who wants to buy a house in 6 months. So this is really for long-term investors who want to, we spoke in the last episode about a passive income.
No, that makes sense. So let's dive into how we actually invest in the stock market and those 3 different ways we can do it. Let's start with direct investing, which I think is a fairly straightforward method, but and is quite popular at the moment, but really does have some downfalls, I think, if you don't know what you're doing. So, James, what is direct investing?
Direct investing is you have a Sharesies account.
Yep.
And a lot of people who can't spell budget still have a Sharesies account. So you might be on Sharesies and you might go, I want to buy a bit of Fisher & Paykel Healthcare or A2 Milk or Tesla or a whole range of different companies in New Zealand, in the US, around the world.
Yep.
So instead of owning a piece of the top 500 companies, you're all into that one specific company.
Okay. And then I guess because it is so easy, signing up for a Sharesies account, getting the app or something like that, what are the pros and the cons of it? Let's start with the pros, and then we'll shift to the cons.
So the pros are you're not paying somebody to do it for you.
Okay.
You've just got to pay a transaction fee, which these days is relatively low depending on how much you're trading. And if you're really good at it, you can make a bucket load of money.
Yeah.
So if you pick a winner and that winner goes up 1,000%, you're happy days.
I'm all in on GameStop.
So it's a huge pro of direct investing.
Yep.
You want to ask me about some cons, Mike?
What are the cons?
So in New Zealand, we're seeing a lot of people who are getting on Sharesies, Invest Now, and Hatch and doing day trading. Of those investors, only 3% will make enough money to make a reasonable level of return.
Okay.
80% of day traders will lose money.
Yep.
And of those 80%, the average loss is 36%. So that is you invest $10,000, you're losing $3,600 over a 12-month period.
I lost it all on GameStop. Okay.
You just got in late, Mike.
Yeah. Okay, let's shift on to the next one. So I guess the next one is active investing. What does that look like?
So active investing is going, and coming back to the direct investing, if I just jump back for a second, if you don't have the time to do the research and make an informed decision and just going off your gut, that's not a great strategy.
Okay.
So some people might go, well, I want to outsource this to the experts. So active trading is going maybe with a Milford in New Zealand, a Booster is another example. All of the kind of broking houses, Jarden, Forsyth Barr, Craig's, they've all got active investment strategies, which means if you pay me a fee, I'm an expert, I will manage your money, and my goal is to make you a greater return after my fee.
Okay. So that sounds a little bit, not more simpler, but I guess less active than direct investing. Someone else is managing it for you. What are the pros? What are the cons? Let's start with pros.
So the pros are, it's much simpler for you. You don't have to invest a lot of time into this. And the idea behind active investing is the markets will drop at some point, maybe every 5 to 7 years, depending on what's happening in the world. In those times, the idea is the ride should be somewhat smoother, so the lows are less low because you've got somebody on the tools with experience. So that's a real advantage. Simple and a smoother ride along the way.
Okay, and someone who has the knowledge and the brain power and the industry expertise is making those trades for you.
Correct.
Okay, cool. So sounds too good to be true. What are the cons?
The cons are very simple, is if you don't have somebody who can outperform the market, you're going to be paying a higher fee without that greater return. So you're going to want to check the track record over a long period of time.
Okay, cool. Let's move on to our last strategy today, which is passive, which sounds nice and easy.
It does. So passive investing might be like the S&P 500, the top 500 companies in the US, opposed to, it's a bit of a blend between active and direct.
Okay.
So instead of just getting somebody to manage your money or you managing it all yourself, it's a blend going, I'm going to invest in the top 500 companies in the world. So if one of those companies falls over, it doesn't really matter. I'm just tracking whatever the market is doing.
Okay, well, it sounds easier. What are the pros, what are the cons?
So the pros of that strategy are the fees are really low because you're not paying for somebody's expertise. Instead of, like for the funds that we use, an active strategy might cost 1%. This might cost 0.3 or even 0.2 of a percent. So if you're investing, so you're lucky enough to have $1 million, you might be saving like $8,000 a year on fees. So the benefit is a lower fee structure. The con is if you have a lot of money to invest, though you are just tracking with the market. So it is going to drop as far as the market drops, opposed to the active, which it might be a bit of a smoother journey.
Okay, that makes sense. So what would your advice be for then someone who's getting into the market, is saving for I'm going to bring it back to property, a deposit for a house.
The sign's off, mate.
I know.
Bring it back to property.
A deposit for a house and wants to put their money somewhere to try and earn some interest or some return or something like that.
That is a very good question. You're full of them today. I get asked that question a lot, going, James, interest rates are really low.
Yeah.
I need my money in six months.
Yeah.
Where should I invest it? I tell people to suck it up, buttercup, and still put it into a savings account where you're not going to make much of a return at all.
Yeah.
Because once again, with those markets going up and down, you don't have the time frame.
Yeah.
So I would say as a minimum, even in like a low risk investment, minimum of 3 years as an investment strategy. Okay. If you want to buy a house, savings account, sorry, the returns aren't very good.
No, fair enough. So as we sort of mentioned, these are long-term investment strategies, minimum 3 years plus. There's sort of a range there that you can pick from. James, you want to close us out?
Yeah, I just touch on all of those strategies. They're right for different people. Active, it's very kind of hands-off. You catch up with your advisor once a year. We've got a bit of a blend between active and passive here with our financial plans.
Yep.
Direct, if you really know what you're doing and you've got the time, you can do really well. The other thing I tell people is if they like it as a little bit of a hobby, that's fine. And passive is great for customers who maybe they've got a couple of properties and they want to learn a little bit and just put in maybe $100 a week.
Sounds good. Thanks for watching this week. We'll be back next week with more checks and balances.